All right, welcome to the first of its kind, world-changing manufacturers network. Lisa Ryan has her ears to the ground and her heart in the game. Get ongoing education and new connections right here with Lisa and the Manufacturers Network. Buckle your seat, listen, and spread the word. Here's Lisa.
Hey, it's Lisa Ryan. Welcome to the Manufacturers Network podcast. I'm excited to introduce our guest today, Ben Hansen. Ben is a 5-time Inc. 5000 entrepreneur who built an 8-figure staffing firm and helped scale a team of over 100 employees in just 8 years with real profits to show for it. Today, he helps $2 to $50 million companies cure what he calls profititis by plugging profit leaks and boosting margins. So if you're tired of working harder for less, this episode is for you. So Ben, welcome to the show.
Thanks for having me, Lisa. I'm really looking forward to talking to your manufacturing audience. Manufacturing is my first love. Out of business school, I was really hoping to get into the manufacturing space. But for one reason or another, boom, here we are 20, 30 years later, and I found myself in high-tech sales and marketing for companies like Dell, Microsoft, myself, and some other startups.
So how did it all begin then? Start us from the beginning and share with us a little bit about your background and what led you to doing what you do now.
Absolutely. As I mentioned, I did work for some startups here in Austin, Texas after going to University of Texas Business School. And then I was at Dell, and then I got recruited to go to Microsoft. And then I left Microsoft, as I say, to sell what I used to buy to the people I used to work with. And so that was marketing and marketing analytics, staffing and consulting services, mostly back to Microsoft. At that time, I had moved to the Pacific Northwest to work for Microsoft, but also some other companies like T-Mobile and Nordstrom's. And I did that for quite a while, as you mentioned, with the Inc. 5000. We were awarded 5 years in a row for being a fast growth company. So I know a lot about growth. I also had a lot of wins in terms of profitability and some pretty decent losses, which really left a mark on me, if you will. And then when I exited that business, I kept scratching my head on what did I do to generate the wins? What did I do to generate the losses? And then I turned that into the business that I'm in now, which is called Profit Doctor, which is why we call it profititis, to follow the medical theme. But basically, profititis is when you have a fairly healthy or solid top line revenue or sales, but weak or anemic bottom line net profitability.
So you explain what profititis is, and I'm sure that we'll get into this during our conversation, but how do you cure it?
Really good question. I tend to divide the world, if you will, into two buckets when it comes to companies. Those within their industries that are above average in terms of profitability, and then those that are below average in terms of profitability. And so when we look at those below average profitability companies and try to think, hey, what are some of the habits or best practices among the above average profitability companies that they could use for themselves? A big one, which I love, is doing less of what's not working. It sounds so silly to say, stop doing the things that aren't working. But when I look across all of my clients who have been below average profitability, the most common thing that they're doing is to continue to pour time, money, and heartache into those things that are not working. And so I help them see through a little bit of the illusion that people have where we have to grow and everything's about revenue, to think, hey, if we focus on profit, one of the ways to get there is to do less of what's not working, less of things that are not very profitable. In the manufacturing space, you might think, what are those things that you're selling, or to whom are you selling things that every time you ship an order out of your factory, you're essentially taping dollar bills to each product?
That's funny because you talk about continuing to do the things that don't work And it's also a thing, I know I've done it, of stopping doing the things that do work. It's
100%. What's sad, and you hear about it all throughout the marketing literature, you hear about it all throughout business and business strategy literature and going to business school. And then, of course, with all the clients that I've had, people spend their time on the squeaky wheel, which is usually the broken thing, the messed up thing, which sometimes needs to be fixed. But often many of those things can just be put to the side and ignored going forward and not do them anymore. And so what'll happen is, for example, the worst sales rep on the team will absorb 80% of their sales manager's time instead of that sales manager spending their energy coaching up and mentoring the top 2 or 3 sales reps who could probably then sell 50% more.
So what are you seeing that are the biggest profit myths in the businesses and the clients that you're working with today?
I alluded to this a little bit before, but I would say one of the biggest profit myths is this idea that revenue cures everything and growth, scale is what it's all about. And so I draw an analogy, and we'll use the sports playbook as a metaphor for this. So much of the business press is about Silicon Valley, tech darlings, unicorns, software as a service, etc. And we'll say that there's a playbook for those kinds of companies, and we'll pretend that's hockey. Why hockey? Why not? But let's think to ourselves, imagine the playbook for those kinds of companies where what they're trying to do is grow as fast as possible using someone else's investment capital so that they can reach some kind of critical scale and take over a market, and then somehow later on become more profitable. Let's pretend that's the hockey playbook. My question is, do you think that hockey playbook is going to be anywhere close to what makes sense for a company that makes spark plugs in Detroit, or a company that builds chairs in North Carolina, for example? It'd be pretty darn unlikely that those kind of companies don't need to turn a profit, have no worries about cash flow, can ask Kleiner Perkins or Benchmark Capital for essentially unlimited money when they run out, and as I said, don't need to make a profit. So let's just pretend that those guys, which is really 95% of the economy, maybe they need the football playbook. So what I invite people to do is to make sure they're using the right playbook.
Okay. And so what are you seeing that are the worst profit killers that they should watch out for?
Ironically, the first one is just profit psychology. As I was talking about the myths before, this idea grow is so darn important versus profitability. So that myth that I was referring to, using the hockey playbook, is where it's all about revenue versus all about growth. And then you were saying, sorry, just refresh me on the second question. I realized I missed a little part on the last one. So just tee me up again on that.
What are the worst profit killers to watch out for?
Worst profit killers. As I mentioned, psychology, focusing on revenue instead of profitability. Very closely aligned to that is the idea that more is always the solution to stuff. So I think one of the biggest ones is less is often the quickest path to improved profitability. Less of the stuff that isn't working. And I alluded to that in a few of the discussions that we just had, or answers that I gave to your questions. But if you think about it, let's say you're a manufacturer and you have a portfolio of 20 products. Chances are the top 20% of your portfolio, so 20% of 20 products is 4. Just pretend that, roughly speaking, 4 of those products are probably your bread and butter. They are the 80-20, right? They are bringing in 80% of the goodness to your company. The question is, what's going on with the worst 20%? What's going on with the worst 4 products in your 20 product portfolio? Chances are you're losing money on those products. And there's a couple of ways to lose money. Maybe just the margins are terrible. Often there's a lot of soft costs, whether it's rework, returns, restocking, or maybe it's one of those things that You get so many customer satisfaction problems associated with those things that the management team is spending, again, the squeaky wheel, 60% of their time dealing with those terrible products rather than redirecting those energies to the top best products. So that's just an example of how doing less of the things that aren't working could dramatically improve profitability. And that is probably, as I said, one of the biggest really tactical profit killers after you get past psychology. How can you look through your company and let go of those things that are not serving you? And again, I appreciate some things do in fact need to get fixed, but so many things that are broken, maybe you're just better off without them.
Exactly. So we talked a little bit about the 80-20 rule with the Pareto principle, but can you explain your 50-20 rule?
Lisa, darn, I'm so glad you asked. So the 50-20 rule, So the 80-20 rule, or the Pareto principle, states that typically you get 80% of the goodness from the top 20% within that category. So very commonly among your sales team, your top stars are generating most of the new business. Among your customers, likely the top 20% are generating 80% of your revenue and profitability. I mentioned before the top 20% of your product portfolio, for example, also responsible for 80% of the goodness. What I think to myself is if the top 20% is responsible for 80% of the good stuff, what is happening with the bottom 20%? And typically that bottom 20% is costing you way more than it's bringing in, essentially profit negative. And so by getting rid of that, you can improve profitability very quickly. And the 50-20 rule that I coined myself, the idea here is to cut 50% of the worst 20% in the next 30 days. So for those of you who are fans of Ron Burgundy and Anchorman 60% of the time, it works every time. This is cut 50% of the worst 20%. And the idea is if we were to look at your worst clients, right? So let's say you have 20 clients, and the bottom 4 are, quote, costing you money. It wouldn't be surprising that 1 or 2 of those bottom 4, there's some reason why it would be very awkward to cut them and stop servicing them in the next, let's say, 30 days. So rather than getting hung up on trying to get rid of all of the bottom 20% immediately, just pick the easy ones. So that's why in the 50-20 rule, we say cut half of the worst 20%, because usually half of them are very easy to cut, whereas the other half, a lot of times there's entanglements. If we were to look across a manufacturing company's workforce, and I won't speak to the union aspect of that, but it would not be surprising that the top 20% are stars, the middle 60% are the middle 60%, and the bottom 20% are not very effective at all. In fact, the Gallup organization, many people are familiar with their polling, probably the preeminent polling company in the United States and maybe the world, has done this ongoing workplace survey for, decades. And they have determined after routinely or annually surveying literally like 155,000 large organizations or divisions within organizations around the world that roughly 18% of the global workforce is actively disengaged. I'll throw out a synonym for actively disengaged, which is toxic. I'll let you pick your own synonym. But my point of all that is chances are, if you've got 100 employees in your business, the bottom 20% are costing you way more than they're adding. And often among that bottom 20%, there are frequently entanglements of some variety. Somebody's brother's nephew, or somebody has an uncle, or somebody's the only one who knows the recipe for something. But then the other half, often everybody would be happier if Friday was their last day.
Yeah, and I use a lot of that in my programs, talking about the fact of that one toxic, horrible person that you have working for you. When people start to quit, it's not your worst employees that quit. It's like they are really expensive to have when you start losing your good people because of that. So I really like that. And I like the entanglements because you're coming in with it's 50%. And sometimes, as much as we hate to do it, we have to fire clients because they are a pain. Nobody wants them, whatever it is. But it's also hard to say no to business when you think you have money coming in until you put that pen to paper and realize that, oh, wow, they are actually costing us money. Maybe we should fire them.
Absolutely. When we look at clients, a big element there is many companies do not run an effective profitability analysis by client. And I would say that's both client by name and client by market segment. So in addition to just cost of goods type calculations, which is very direct, typically materials and maybe direct labor, there's a lot of other costs that might get you into more of a contribution margin style calculation. And even that frequently does not include a lot of the soft costs that are a little bit harder to attribute to that. But there are just reams and reams of study data from Harvard, Stanford, business schools, and Deloitte and McKinsey and all these guys about how the worst clients, again, whether it's by market segment or by name, is really dragging a company down. I've got a couple of B2B clients right now that have both roughly about 360 customers. And unsurprisingly, the top 10% of their customers, 90% of the revenue. The bottom 20% of their customers responsible for roughly about 0.5% to 1% of revenue. And when you think about all the energy that's going in for that company to basically maintain 20 to 25% of that bottom end customer base, there's a lot of calls from accounting. There's sales calls. There's stuff that goes out. These are a lot of corner case clients that want stuff that you don't really do. They're the low volume clients or often the pain in the butt clients. And frequently they cost you much more than they're bringing in. And that's the analogy. Every time you load up their shipment, you're taping whether it's $100 bill or a $10,000 check to that order.
Wow. So speaking of accounting, so how do you feel that sometimes accounting undermines product profitability?
What I find with so many people that I work with is that they got into this business not because they were a Harvard or Wharton trained or business mind or financial person or CPA, and then they looked around and thought, I'm going to get into stamping out auto parts. Many times they grew up, their dad was a plumber. Now they got into plumbing and now they've got a $15 million plumbing business. Or they grew up being an expert in the thing that the business sells or in the thing that the business does. And in so many cases, for these folks, accounting and finance is a secondary language. And what I find is it's so surprising. I won't say it's surprising because I'm not surprised anymore, but I continue to see that very frequently accounting and bookkeeping is really not about explaining those financials or presenting them in an easy to understand way. They tend to be more about tax and regulation and compliance. And so what I would suggest is, first of all, recharacterizing your financials in a more simple way. Commonly, I'll see somebody with a 7-page P&L, and that's what they look at first. If let's simplify this thing down to maybe 1 page or 1.5 pages, so the forest isn't lost for the trees, so to speak, or you get the high-level message. And then later on, if you need to drill down, you can drill down. But so I think step one, simplified financials that include the context that makes it really easy to understand for non-finance wonks to look at those financials and really get the obvious insights. And then, of course, very valuable that the CEO and the executive team has at least a middle level of understanding and education on how to read those in order to ensure that they're using the numbers to manage the business. Once it gets beyond what you can see without moving, you really need to start using the finances and the financials to be able to manage that business.
So, with all this being said, is it really possible to grow the bottom line without increasing revenue?
100%. The absence of a negative is a positive. I sometimes reference this example from Michelangelo. For those of you who are interested in Renaissance architecture and sculpture and so forth, you've heard of that guy. He painted the roof of the Sistine Chapel, and probably one of his other big masterworks was the David that you may have seen in Florence on vacation. And anyway, this big block of marble is huge. It's 16 feet tall. It had been lying in some quarry for 40 years. No artist would take on the commission from the Vatican because this big chunk of marble had a huge crack in it. Anyway, so Michelangelo takes it on, fashions the David. It's now one of Western art's masterpieces. And they asked Michelangelo later, how on earth did you do this? Because it had this huge crack in it and it was so impossible and blah, blah, blah. And he said, I looked at the block of marble, I envisioned the David, and I carved away everything that was not the David. And that is one metaphor for what I'm talking about. When you look at your, let's just say, $250 million company, is there in that business, that's not profitable or very poor profitability? Is there a highly profitable $200 million company inside that $250 million company that if you were to, let's just say, carve away one division or 3 product lines or one customer segment or your operation in insert geographic location, would you have that highly profitable, slightly slimmer company? And what I find amazing is that sometimes when you slim down a little bit, you get a really high-performing, slightly slimmer business that is actually much more tuned for fast growth for a couple of reasons. Usually you have the cash to do it because you got rid of the thing that's draining your cash. But the chunk that has been draining your cash has also likely been draining your joy, enthusiasm, energy, and time. And what I invite CEOs to do, who's mainly who I work with, is to take some of that time and money and invest it back in yourself. Take that vacation you haven't taken in 3 years, or spend Saturday night with the family instead of at the office or whatnot. But then maybe redirect a chunk of that to, instead of trying to fix the stuff that can't be fixed, to double down on your sweet spots. And so that's a little bit of the Profit Doctor formula, which is profit psychology. Number 1, get focused on profitability. Number 2 is do less of what isn't working or what doesn't work. I call that my profit accelerator. And then that's a program that I offer. A second program that I offer is the Profit CFO, which speaks exactly to what I mentioned a minute ago, which is to provide more simplified financials that have easy insights for people to see to help them manage their business. We skill them up a little bit on analyzing those reports and knowing what's important. And then the fourth chunk is profit growth. And that's where you redirect some of your saved resources that you recouped by cutting the things that aren't working, time, energy, and cash, into doubling down on your sweet spots. The cool part is when you double down on selling more of your best products at full price to your best customers with your best sales channels, it can be very highly margin positive.
That sounds amazing. We have covered a lot in our time together. If somebody did want to get in touch and continue the conversation, what's the best way for them to get a hold of you?
I definitely invite them to come to my website. It's www.profitdoctor.com, spelled the regular way, PROFIT, and then doctor, DOCTOR, and schedule a check-in with me if you're the CEO of a company that's below average profitability. Certainly anything negative and low single digits is below average. Depending on your industry, average tends to run somewhere between 6 and 10%. If you're up in those double digits and you're a relatively smaller company, just make sure you're not artificially boosting your net profitability by having the owners take artificially low salaries. I see that so often where, let's say, management or CEOs, and these tend to be smaller companies, say under 50 million, where they are taking a below market salary for the equity stakeholders because things aren't going so well. Or maybe they are going when they're trying to reduce their tax burden, but then that artificially inflates their perceived net profitability. So if you're worth $500,000 and your salary is $150,000, you are subsidizing your bottom line by $350,000. And for, we'll just make it up to make the math easy, for a $3.5 million company, that's a 10% bump. For a $7 million company, that's still 5%, which is often the difference between thinking things are going great, I'm at 13% net profit, and you're like, come to think of it, I'm really only at 7 or 8 because we're subsidizing that bottom line with below market salaries for me and my 3 co-founders.
Wow. Ben, it has been such a pleasure having you on the show today. Thanks so much for joining me.
Thanks, Lisa. I'm glad to see, because I can see you, that you still got both your ears. I haven't talked them both off, but somehow I just get excited about this stuff, and I love helping people improve their profitability. And in this day and age where we're supposedly reshoring so much manufacturing back to the United States, and it's a difficult time with tariffs and cost pressures and uncertainty, nothing is a better hedge against all that stuff, tariffs, difficulty in the labor force, margin pressures, than a fat bottom line. So reach out to us at profitdoctor.com. I'm also on LinkedIn, Ben Hansen, Hansen, and it's Profit Doctor, easy to spot. So look forward to talking with some of the CEOs that are your regular listeners who are like, hey, I'm sick of working so hard for these kind of skimpy returns. And gosh, if you're ever trying to sell that company, since it's going to be evaluated on EBITDA, why not get some help now on boosting it up?
That is a great way to end the show. I'm Lisa Ryan, and we will see you next time. Thanks for listening to the Manufacturers Network podcast. Do me a favor and share this podcast with your friends and colleagues so we can grow this network and connect more fantastic folks just like you. You can either send your buddies to the website at manufacturers-network.com or share the Manufacturers Network podcast on your LinkedIn, Facebook, Twitter, Instagram, or wherever you and your industry friends hang out. The bigger and faster we grow the network, the stronger and deeper the community will all have. Thanks again, and I appreciate you.